joining us, Mr. Sunil Duggal, the former CEO of Dabur, as well as Amnish Aggarwal from Prabhudas Lilladher. It's also important to get commentary from both our experts today because what is being flagged off in operational updates from a Marico to a Godrej consumer is slowdown in demand, particularly in the smaller towns and rural parts. Mr. Duggal, good morning. I'm going to come to you first. You've seen so many cycles at Dabur. You've seen so many cycles at Dabur when it comes to inflation, coming down. I'll begin first with the big question, which is of red hot inflation, just the way prices have run up, the war premium that was there on prices, which is now coming down, the softening that is coming down in prices that we're seeing. But when, going by your expertise, going by history, but when do you see FMCG companies start to normalize prices and, of course, packaging, because we started to see shrinkflation as a big trend as well?
A lot depends upon the consumption side. I think that's where the stress lies, not really in terms of input costs to that extent, because those are, as you said, easing off. But as far as my knowledge goes, the consumption stress remains quite intense, particularly in rural areas. So even if it is the margins are partly mitigated because of lower input costs, it's not going to solve the problem which FMCGs have. Now, having said that, I certainly expect the second half of the year in terms of performance to be better than the first half, which was a bit of a write-off. But will we go back to the heady days of 5 or 6 years ago? Probably not in a hurry. I think there's a long way to go. There are structural issues in terms of disposable incomes, in terms of employment, et cetera, which will be a drag on the sector. But definitely the margin improvement is visible on the back of lower petroleum costs and lower edible oil costs in particular, and there will be some secular fall in other commodity costs because of the good monsoons. So that will be quite a relief. But will it really fuel demand? I have my doubts.
You don't think the price cuts, the pass-throughs in price cuts that are taking place will be enough to bring down demand? I'm going to come back to you in that just a bit. It's something HUL Chairman Sanjeev Mehta has also flagged of the degrowth that the HUL is seeing in the rural hinterland. But before that, Amnish, just a quick word as far as the markets go. We're now talking at a time when the government is also instructing companies to ensure that the consumer benefits from the softening of prices, that edible oil prices should come down by 10 to 12 rupees in a week to 10 days' time. So as we start this earnings season, can I begin by asking you expectations on the margin front that we're going to see this earnings season?
This earnings season is not going to be great because of the simple reason that the prices have gone up significantly over the past 6 months, and the demand recovery which was expected earlier, I think that might be little delayed because monsoon was also very patchy, even say up to a couple of weeks back. So as far as your this quarter earnings are concerned, one should not build too much expectations on the margin front in particular. Although companies have been taking price increase, unless and until they cut back on cost, they cut back on ad spend to sustain the margin, which several of the companies have done even in the previous quarter. I think discretionary pack is one where the base effect is favorable because you had two consecutive years when 1Q was impacted due to first and second wave of COVID. So those companies will report very robust numbers. But I think in general, if you look at in consumption space, it will be a very mixed bag with discretionary is doing well and staple companies, I would say, more or less not doing that great.
Mr. Duggal, the FMCG sector has gone through horrible, terrible and rather challenging times. Demand has got crushed and margins have been under pressure. Demand has never got crushed historically. So what happens on the demand front? Crude coming down, palm oil coming down, soap prices coming down, that all is price adjustment. The ultimate problem, Mr. Duggal, is that the decline in commodity could actually crush demand further because the rural income will come under pressure. The farmer will have less money in the hand. The entire chain, which in a sense has benefited because of commodity inflation, they also will lose out. So this actually could be a squeeze rather than an advantage, Mr. Duggal.
Not necessarily. I think some softening in terms of the commodity prices, especially petroleum, is not going to be having any impact on the rural producer. There's no link there. Of course, you're right to some extent that lower prices of, say, sugar or wheat, etc., would squeeze some incomes in the rural segment. But ultimately, the consumer is far bigger than the agrarian producer, and the net impact will be positive. But the demand side, which you alluded to, I think that is a cause of concern. There is some structural issues with regard to demand. And we thought it's more of a COVID impact, but the COVID is now done and dusted. And now we are on a normalized base. So even then, I do expect volume growth to be in the second half of the year, not to be more than low to mid single digits, which is simply not good enough for the sector. So till the consumption stress is released, whatever little impact on margins will, yes, maybe flow down to the bottom line. Maybe there'll be a pass through. And as Amnish also alluded to, that there is no much further play in the P&Ls to support further cost cuts. I think advertising has been cut down to the bare bones. Employee costs also have been coming down progressively. All kinds of supply chain efficiencies have already been captured. So now the top line has to drive the bottom line. And that is a little bit suspect as far as we are concerned, in the near term at least.
Do you buy this theory, Mr. Duggal, that in this kind of a commodity inflationary environment, the branded players, the big players, they will only continue to gain market share? That historically has happened in the past, which is that Tata consumer will gain more in the tea market, Dabur will gain more in the honey market, Asian Paints will gain more in the paint market. Do you think that transition is only going to be more and more evident in this entire cycle?
Only if they pass through a lot of input cost reductions. If they don't do that, actually the demand side will flow to the unorganized players. Now, suppose, let's say, a company operates at a 10 rupee price point and is finding the margins as unsustainable at the 10 rupee price point. If it vacates the 10 rupee point, that space is not going to disappear. It's just going to be occupied by somebody else, most likely the unorganized player. So I think the branded players don't have any significant advantage other than distribution reach in terms of situation. So there may be some benefits because distribution progression is still happening. The last mile expansion happens even in today's situation. But there's no substitute for the affordability factor.
Right. You know, Amnish, while valuations currently of FMCG stocks are below their historical 5-year averages, do you think that the consumer pack is attractive at this point? And more importantly, how long is it going to be? Because, you know, while no one's debating the growth that FMCG stocks do, factor in or project, but it's always about valuation after a point with FMCG names.
Okay, so Aisha, if you, as you said, on a 5-year basis, many of these stocks might look cheaper, but if you look slightly longer, say a 10-year periods, they are still trading at a significant premium because the P multiple in many of these stocks, they have gone 2 times, 3 times over the last 10 years in particular. That is one. Now, secondly, you see, these commodity cycles are very volatile. You look at what has happened in the last, say, 10 or 15 days, the way the palm oil pricing and some of the other input costs, they have seen a meltdown. So, liver has practically rallied from something like 2100 to 2500. Now, this 20% sort of a rally in liver is, I would say, it's a very big number. Now, there is very little scope for the companies to cut costs, whether it is advertising or you can say overheads. So even if, for example, some part of the costs which will come down, they will be passed on to the consumer, because otherwise, as Mr. Duggal also said, unorganized sector will tend to gain in such an environment. So I think there is very little room, even if we presume that their margins will increase, and we should not forget that for in all the analyst estimates for FY24 in particular and 25 someone has done, people are already factoring in normalization of margins. So if we are looking at P multiples beyond FY23, then already you can say the margins are normalized, and I think post the kind of rally we have seen in some of these stocks, it has to be substantiated by a significant increase in volumes in the coming quarters, because whatever undervaluation, or you can say if you look at 5-year average or something, I think quite a lot of it has got corrected in the last week or 10 days.
Right, okay. Amnish, as well as Mr. Duggal, great to have you on the show today and analyze what's really going on with the FMCG pack in particular, given the kind of commodity cool-off that one has seen as we speak right now.